Welcome to Ripple Edge, where we cut through the noise and give you the real picture on XRP. Let's get into it. Smart money doesn't announce its moves. It positions quietly, accumulates steadily, and by the time retail catches the headline, the setup is already done. Right now, the on-chain data and volume patterns around XRP are telling a story that most channels aren't reading correctly. So if you want the actual picture, you're in the right place. Before we go deeper, hit subscribe right now. This kind of analysis doesn't wait, and neither should you. Here's what the surface level coverage keeps getting wrong. Everyone is talking about price. Price is a result, not a signal. What matters is what's driving accumulation behavior before price reacts. And right now there are three converging factors that serious XRP holders need to understand clearly. The first is regulatory clarity momentum. For years, XRP carried the weight of the SEC lawsuit like an anchor. That suppressed institutional appetite. Big funds don't allocate to assets with unresolved legal designation. It creates compliance risk they can't justify to their boards. But the legal landscape has shifted materially. The Ripple case produced a ruling that distinguished XRP programmatic sales from institutional sales, a distinction that matters enormously for how asset managers classify XRP exposure. That ruling didn't flip a switch overnight, but it started a clock. Institutions move slowly, they do diligence, they build frameworks, and then they move in size. That process takes quarters, not days. If that clock started ticking after the ruling, we are now deep enough into that diligence window that allocation decisions are being made right now. Not announced. Made. The second factor is the macro environment for cross-border payment infrastructure. Global correspondent banking is a $45 trillion annual flow market. The average cross-border transaction still settles in 2 to 5 business days and costs between $25 and $65 depending on the corridor. That is not a technology problem anymore. The technology to fix it has existed for years. What's been missing is regulatory comfort and institutional rails. RippleNet and the on-demand liquidity product using XRP as a bridge asset are already live in corridors across Southeast Asia, Latin America, and the Middle East. This is not a white paper. This is production infrastructure processing real transactions. When global payment volumes run through that infrastructure, XRP is the liquidity layer. That's not speculative, that's contractual. Now here's where it gets sharp. The chart you need to look at right now is XRP's price stability relative to Bitcoin's volatility in recent drawdown cycles. In previous bear cycles, XRP tracked BTC down and often fell harder. What we've seen in more recent corrections is XRP holding support levels with significantly less drawdown percentage than altcoins of comparable market cap. That kind of relative strength during risk-off periods is an institutional accumulation fingerprint. Retail panic sells into weakness. Institutions use weakness as a buying window. When an asset holds support during broad market fear, it means there are large buyers absorbing the selling pressure. That's the chart. One data point, one clear implication: someone with size is not letting XRP break below certain levels. The third factor is the broader digital asset infrastructure build-out happening at the sovereign and central bank level. Over 130 central banks are actively exploring or piloting central bank digital currencies. The BIS has published frameworks. The IMF has weighed in. The Federal Reserve's FedNow system is live. The conversation has moved from whether digital settlement infrastructure gets built to who builds it and on top of what. Ripple has been in rooms with central banks. They have signed agreements with the governments of Palau, Montenegro, Colombia, and others to explore CBDC infrastructure. This is not marketing. These are government contracts. And the asset sitting at the center of Ripple's liquidity solution is XRP. Here's what they won't say on the channels running 16-minute hype videos with zero primary sources. The XRP opportunity is not emotional. It is structural. The thesis is not built on vibes or community excitement. It's built on a specific problem: slow, expensive, opaque cross-border settlement, and a specific solution that is already deployed, already processing volume, and already integrated into financial institution workflows. That's a fundamentally different risk profile than a project still pitching a future use case. But here's the edge that separates informed holders from noise chasers. Knowing the thesis is not enough. Timing and psychology are where most people destroy their own returns. The pattern in assets like XRP that have strong structural theses but choppy price histories is that retail investors buy the spike, panic on the retest, and exit right before the next leg. They confuse short-term price noise with thesis invalidation. These are completely different things. If the cross-border payment problem is still real, and it is, if RippleNet is still adding partners, and it is, if regulatory clarity is still improving, and it is, then a price dip is not a signal to exit. It is a signal to check your thesis, and if the thesis holds, hold your position. The real play right now is not trying to time the exact breakout candle. The real play is understanding that XRP is sitting at the intersection of three massive secular trends: the digitization of global finance, the reform of correspondent banking infrastructure, and the maturation of crypto as a regulated asset class. Those three trends don't reverse, they compound, and XRP has first mover advantage in a specific niche, institutional cross-border liquidity, that is extraordinarily difficult for a competitor to displace once integration contracts are signed and workflows are built around a specific asset. What you should actually be tracking going forward: watch RippleNet partner announcements, specifically in the Middle East and Asian corridors where dollar to local currency conversion costs are highest, because that's where the ODL value proposition is sharpest. Watch for any SEC rulemaking or congressional action on crypto asset classification, because formal legislative clarity is the last unlock for the largest institutional allocators who are still sitting on the sidelines. And watch XRP's market cap dominance within the altcoin space during the next risk-on rotation. If it leads rather than lags, that's your confirmation signal that the institutional accumulation thesis is playing out in real time. The bottom line is this: XRP is not a meme. It's not a prayer. It is a technology product with a live commercial deployment, a specific target market with trillions of dollars of annual transaction flow, and a legal and regulatory situation that has materially improved from its worst point. The signals building right now are not random. They are the result of years of infrastructure build-out, legal resolution, and institutional diligence cycles converging at the same moment. You either see that picture clearly or you're trading on noise. Now you see it clearly. That's the edge. Stay sharp, subscribe so you catch the next one before everyone else does.